Hey everyone, what's going on? Welcome to another video. Today is March 30th, and in today's video, I'm going to walk through 5 put credit spread examples of option strategies that you can use to create weekly, monthly income. I'll walk through just a few examples with about a 3-week expiration. You can do it weekly, you could do it monthly, and you're probably wondering what is a put credit spread if you're new. Put credit spreads are a neutral to bullish option strategy that you can use to collect option premium the second you execute the strategy. So I'll quickly walk through 5 of them. The first one I'm going to walk through with it is Adobe, and I'll explain kind of the setup for this first one. And right before I jump into the option area, if you could like and subscribe, it'd really help out and support the channel. If you have any stocks you want me to cover, definitely comment down below. If you have any other option strategies you want me to cover, comment down below. Really looking forward to see the channel growing and seeing the engagement. So now jumping into Adobe for the first example, you'll click Trade Adobe Options down here on Robinhood. Robinhood has a really good user interface in my opinion for options, so it's really good to kind of take a look at them using the platform. So a put credit spread. Let's quickly walk through how to set up a put credit spread. And the first thing you're going to do is you're going to change the expiration date. So for the examples today, I'm going to go to April 21st. Personally, I like looking at put credit spreads and options about a month out. It's a little less than a month out, but it's the 3rd week of the month, which there's much more option volume. So as you can see, if I click here on the first leg, there's open interest of 215, not a ton. Here's 1,000, open interest. Definitely note this is after hours, so that could affect kind of the volume, what you're seeing, and whatnot. So what you're going to do, so there's going to be 2 legs to this option strategy. There's going to be one put that you sell and one put that you buy. For example, I'm just using the current strike price of kind of where the stock's trading right now. You're going to sell one of these options, and in theory, if you just did a cash secured put, you just sold one put, you would need $37,000 to execute this trade, and you would collect $935 today. So when you execute this put credit spread or you sell a put, you collect this premium immediately. That is in your account today. This is a cash secure put. I want to do a put credit spread. So what I'm going to do is I'm going to then buy a put at a leg lower. So for this example, I'm going to do the 375. So if I click there, I'm buying the 375 put. Effectively, I have a spread now of 5 points between these 2 strike prices, and the total credit I'm going to earn is $165. And remember, this $165, if I execute this put credit spread today, it's in my account today. And if the option expires worthless in 20 days, 22 days, then nothing happens. The $165 is already in my account, and that's it. If Adobe continues to fall below 380, 375, then that's where you will hit your max loss. So you will lose $310 because you put up 500 for this 5-point spread, you collected 165, so the delta there is 310. So here's where you would hit your max loss. So that's a quick setup for Adobe of how you would do a put credit spread. And this is a little bit more aggressive because it's trading right at the current stock price. You have to think, is the stock going to continue upward? Is it going to stay neutral? Also, you have to figure out what's the risk and reward ratio you want. Right here, it's about a probably third return, 33%, 165 out of 500. It's about a 30% return. Now, looking at Airbnb, jumping over to the second example, I'm sure everyone's heard of Airbnb. The one thing to keep in mind is you're going to want to look at the earnings timing of when earnings are happening. So expected May 2nd, so far out beyond April options we were looking at before. So for Airbnb, we're going to go to the same area, trade Airbnb options. You're going to go put, you're going to go to sell, and you're going to change the date here. So the expiration date. So I'm going to go April 22nd, April 21st, 22 days out. And for this example, I'm going to go a little bit more conservative and just show you how it's done. I'm not saying copy these by any means. This is just an example. So you would sell this put. So you're selling one leg. In theory, this is a cash secure put. But now to make it a put credit spread, you're going to buy a put a leg lower. So it's interesting, you can see here there's strike prices at $1 increments. In theory, I typically go about 5-point spreads, so $500 of collateral essentially up at risk. So here, top right, you can see 115 put is being sold and 110 put is being bought. So you're protecting yourself on the bottom because you don't want that full exposure of selling a cash secured put because you may not have $11,500 to sell a cash secured put. So right here you can see today if you do this trade, if you do this put credit spread, you will collect a total credit of $84 today. You will be in theory putting up $500, so that's roughly a 15% return in 22 days. Again, you have to keep in mind, do you think Airbnb is going to come down to 110, 115, or do you think it's going to remain neutral, or increase in it's a little bit more bullish? So this is an example on Airbnb. The next example is going to be on Nvidia. Nvidia manufactures computer graphics chips, etc. And as you can see, the earnings date here is May 24th. So that's outside the timeline of what we're looking, which is good. So jumping over to the options area, you're going to go to put, you're going to go to sell, you're going to change the expiration date to April 21st. And let's see what this looks like for Nvidia. So here, let's go at about a 265 put. So we're going to sell this put. And then we're going to switch the selection up top for the second leg to buy a put. And interesting here, it's 2.5 point spread between strike prices. So that's interesting. You could do a little bit smaller of a spread if you don't want to do a 500 spread. Let's say you stick with the 500. So we're going to buy this 260 put. You're going to protect yourself at 260. So this is making it a much smaller amount of capital exposed. Here, you would get a total credit of $140. So today, if you executed this put credit spread, $140 would be deposited into your account today. If the option buyer is worthless, nothing happens, $140 stays in your account. If it doesn't, you will have a max loss of $345. As you can see here, again, this is roughly a 30% return. If you want to be even more conservative, I can show you a quick example. If you want to go down to, let's say, the 250, pretty far down, let's go to sell a put. So we're going to change that back to sell, 250. So sell that one, buy a put. So let's go to the 245. So here's 72 cents or $72 because one contract has 100 shares. So $72 would be your credit today. If you're putting up $500 for this 5-point spread, you would collect 72. It's slightly above a 10% return, 10 to 15% return. So this one's worth looking into, a little bit more conservative, but that's kind of how you can get a sense of, what's the ROI and what percentage you're looking for to earn. And now the fourth example, American Airlines. So this one's a little interesting because American Airlines is much cheaper from a stock price perspective. If you want to sell a cash secure put on American Airlines at, let's say, $14, you'd only need $1,400 versus some of the other ones, you need $27,000. Now looking at American Airlines, the earnings date is April 27th. So this one could have a lot of option volume because it's much closer to the earnings date, which could be good from a premium standpoint. So let's take a look. April 21st. This is very close to the earnings date. Now, changing the selection up top, we're selling the put for the first leg, so 14. So if you sell this put, and then you buy this put, let's go to 13. This one's really interesting. You would collect only $8, but the delta between these two, it's actually only 50 cents. You're putting $50 at risk to collect $8. That's actually a very small amount of collateral, and this could be a great example or great stock to use for much smaller accounts. You only have to have $50 to execute this put credit spread on American Airlines. Yeah, $8 doesn't seem like a lot, but if you do this multiple times, it will add up, and you're only starting with $50. If you do this 10 times, you collect $8, you put up 50, then you would have $80. That'd be almost 1.5 times the initial 50 that you put up. So this is a great example of kind of how the legs and the strike prices, how they can vary and how much collateral you'll need to execute this trade. So max loss is 40, max profit is 10. So this one's really interesting. Now the last one is Palantir Technologies. I'm sure everyone's heard of Palantir, and you can see the chart. It's come down but somewhat stabilized. Palantir, let's take a look at the earnings date. So the approximate earnings is May 9th, so that's good. Now we're going to trade Palantir options. We're going to change the expiration date and put and sell. So the first leg for Palantir, this is another one. It's a very low price stock for selling a cash secured put at $8 would only require $800. So this is a very small account friendly stock in that sense. Now if we're gonna do a put credit spread, we're gonna choose an option leg lower than the 8 that we just sold to buy. So let's do this 750. So here you can see we're putting up again $50, the 50-cent spread between the two strike prices, and you're collecting $15. So that's an awesome return. That's 30% return right there. Again, this is pretty much at the money almost because it's $8. So let's see if this could work for strike prices a little more conservative. Not really. You could do the 750 and you could buy the 650. Here you would collect $10. You would be putting up 100. So that's a 10% return. From a percentage standpoint, that's not bad. So worth considering. If you found value in the video, quick reminder, if you could like, subscribe, feel free to comment down below and check out the links in the description below. There's a couple awesome books from Amazon that I've used to learn these strategies, and really looking forward to the next video. Talk to you soon.